Guys, it is like my last full day in Bangkok here. Came up to the rooftop on this skyscraper. Guys, look at the freaking skyline. It's just so different from anywhere back home, at least for me. Even downtown back home, we have a couple big buildings, you know, some big buildings, but there's just so many as far as you can freaking see out here. It's so crazy, but getting a little tan this morning, some morning sun. It's actually about like 11 something, so not a late morning, but get some late morning sun. I wanted to share with you guys the Mastermind. I wanted to share the days of our Mastermind because it's so important that you guys get in and get started printing, especially when values are down to where they are now. It is so valuable to get started now versus at all-time high when things are safe, when you feel safe to get started. You need to be getting started when things are boring, when things are scary. And so there was lots of value given at this Mastermind. Day one, which I'm going to share with you guys here in this video. Day one is all about creating the actual systems that will make you money every single day to get cash flow in, because cash flow in is what gives you the life that you want. It's what allows you to just be staying here in Bangkok, doing Lord knows whatever it is you want to do. It allows you to travel wherever you want to be. It allows you to work the job that you want to work. It allows you to be who you want to be, and that's going to be cash flow. Cash flow equals freedom. Cash flow is what actually gives you the freedom. Buying a bunch of Bitcoin, you know, it's really cool, long-term, great play. Obviously, I believe in this as well. Obviously, I want to hold as much Bitcoin as possible, but it's not going to give you the freedom now that you're looking for. Learning how to monetize that Bitcoin to get cash flow in every day, cash flow online. It's better than even an online remote job because it's from anywhere in the world, any country in the world, all the time, 24/7, permissionless, cash flow every single day. And that is what will actually give you the freedom that you're looking for, not just buying Bitcoin. If you hold your Bitcoin for 10 years, yes, that is going to perform very well. It'll set you financially free, I believe. It's going to make you lots and lots of money. But cash flow is what will give you the freedom you're looking for today. And so it's very important you guys pay attention to this video. I would recommend definitely putting out a notebook, taking some notes. I'm gonna put some of the PowerPoint slides on screen so you can pause the video when they come up and then you can write those down, take a screenshot if you want, that's fine. The information is always free, but it's very important that you guys pay attention. People pay thousands of dollars to attend this event to learn the lessons that you're gonna learn here today. So it's very important that you take this information and not just learn it, not just write it down and take notes, but actually take action. Take action day one. Take action today as you watch this video and you start to learn the concepts of DeFi, what it actually is, start to understand it. You can then actually get started. Open your first pool. Make sure you have Rabby Wallet downloaded, okay? Download Rabby Wallet as you're watching this video as well. Get your seed phrase set up on a brand new wallet and then send some Ethereum over. Open your first liquidity pool through VFAT with Rabby Wallet. Just get your first one going, because if you can do anything in DeFi with $10. Guys, you can borrow that from your freaking kids if you have kids. I mean, $10. Everyone has $10 and you can start your first pool with literally $1 if you wanted to. Again, you could just borrow that money from your freaking kids. It's not exactly hard to obtain. If you don't have $10, you're probably watching the wrong video to begin with. But open your first pool today if you haven't already. And then if you can get the systems going to learn how to create cash flow, to understand what's going on in your liquidity pools, all you have to do from there is just scale. Just scale your portfolio to get you to the income level that you want. If you need to make 10K a month to be free, you just got to scale to where you're making 10K a month. Scale your assets that are being supplied. If you only need 5K a month, even easier, 3K a month. If $1,000 a month would change your life and you could live digitally out here in freaking Bangkok or Koh Samui. We left Ryan out there. Ryan decided to stay. He's just going to live out there. That's the freedom that you have when you have liquidity pools, the freedom to choose the life that you want. So guys, again, just please pay attention to this video. Take notes, get a notebook out, screenshot the slides if you want, take the information, but it's so important that you implement it. And guys, as you watch this video, if you do have some crazy questions coming up, just drop them in the comments, or of course, book a free call down below. Book a call with me where we can work one-on-one and get you set up to cash flowing as soon as possible. Guys, just pay attention, and I'll see you at the end. Thank you for being here. Koh Samui, it's beautiful. Hopefully everyone slept great. So here's my objectives for you guys. A 3-day overview. Hopefully you can see the glare is crazy. But my objective for you before you leave, to build a self-sustaining system, that you guys actually leave with a system that's going to compound itself over time and be buying you assets back, and more importantly, just buy your time back, buy your freedom back, to where if you didn't want to leave, you guys could hopefully just stay here forever. That's the goal. Or come back and make a life out here. I'm going to treat you, especially tomorrow, how to leverage your equity. So actually treating Bitcoin as property. Leverage your equity inside Bitcoin, other blue chips as well, to build your cash flowing crypto business and create this infinite flywheel where it's going to become an income that perpetually just grows your portfolio over time. And it's going to give you the life you desire. So today we're going to focus on DeFi as a business, operating your liquidity pools as cash flow positions because we need to get the income in. We have to master those fundamentals. Tomorrow, again, we'll focus on the actual flywheel, how to make the game infinite to where it feeds itself over time. And then day 3 is going to be how to scale and how we can survive bear markets and anything the market does throw at us. So, okay, DeFi, running it like a business. Some of you guys have heard this before, so little repeats here, but it's a service-based business. So it's not a fugazi, it's not a fugazi, it's not just free money you're making. You're actually providing a service. You're providing swaps for investors and traders, and you are providing the actual assets that they're swapping between. It is a real business. It's the mom and pop exchange. It's small business version of Coinbase, Kraken, Gemini, big names in the space, Binance. It's the mom and pop version. And our competitive edge is we have the lowest rates. We're fast, we're permissionless, we're not holding your passport for 3 days, waiting for you to get verified or anything like that, and we're serving blue chips. To really keep that edge, we want to make sure we are in blue chip assets that will always have that demand. And our focus, again, is going to depend on asset quality, TVL we're going to go over, setting ranges, managing impermanent loss, etc. And we're just trying to take you from being someone that's just been hodling your crypto, hoping something happens, hoping you make money, and actually start making money on day 1 as a business operator. So I told you guys I was going to do a lot of comparisons to the real estate world, property versus Bitcoin, showing that you own your Bitcoin and how we can monetize it. In the real estate world, you own your title, you own your home. A lot of you mentioned you guys own your home. And then there's potential to cash out refinance where you can pull equity out of your home. That's something we can do in crypto as well. Your collateral usually being the house itself. Bitcoin has the same opportunities. You own your Bitcoin, you own your keys, you own your coins. Story as old as time. DeFi borrowing instantly without credit checks, without anything like that. We can be pulling equity from our Bitcoin, which we will go over heavily tomorrow. And digital collateral. Your Bitcoin is the collateral. This can all be done from a laptop, from your phone, in Koh Samui, Bangkok, US, UK, Australia, wherever you may be from. India. Not India. And key insight there as well, we're going to be using equity from quality assets to fund the actual cash flow business. So the usual model, I've taken a lot of principles from the real estate world, from successful real estate investors that have been in the game for years and years and years, and from private equity as well, and I've applied it to crypto. And this is how I actually run my portfolio. Owning your home is easy. A lot of people would say that if you're just owning the home, it's not really as much an asset as it could be a liability. Problems with the house, etc. But buying the house creates the asset. You hold the title, but it sits empty. You're making no cash flow. It's sometimes considered, I would say, a liability if you're just living in it. When you're taking it like Joe and you're renting it out, finding tenants, this is the hard part. You're finding tenants, you have maintenance, management, but it's what transforms it into an actual business.
And a leaky roof.
And a leaky roof, exactly. But this is how you actually, this is the hard part. You're renting it out, it's the hard part. Managing the home is the hard part, but it's what gives you cash flow. And that's why today we'll be focusing on the hard part of DeFi as well. But ownership, you own the Bitcoin. You self-custody your assets. It sits in your wallet. It has the potential to appreciate, but a lot of people that are hodling, they need it to appreciate. And that's where we're changing the game. Set ranges, running liquidity pools, running the exchange that allows others to trade. And that's what actually builds our income, is facilitating trades. We're monetizing volatility. We're monetizing greed, monetizing fear, monetizing the market going sideways, making money every day. This is the hard part. Owning the Bitcoin's easy. You just buy it. This is what we're focusing on today. So again, for some of you, this may be a bit of a refresher, but what is a liquidity pool? It's your own mom and pop exchange. It's permissionless, it's fast, it's instantaneous. People are saving money. They're spending only a couple bucks, couple cents versus hundreds of dollars on Coinbase. A 10 grand transaction on Coinbase, I've seen quoted with a $250 fee plus. The same 10 grand swap through DeFi can be $1, $2, maybe $3 max. It saves people a lot of money. You are stocking the shelves with two currencies. That might be Bitcoin and USDC, Ethereum and USDC. And when customers trade that specific pair, the fees that they pay are going directly to you. It's 24/7. You have no employees, no overhead. You just have to have the inventory to actually offer. And again, we're cheaper, faster, permissionless, And again, we're saving people money. It's a real business, and you can feel good about it because we're saving people money, giving them instant access to liquidity, and we are making money the same. You provide liquidity into the pool. When traders are swapping, whether they're bullish, whether they're short-term traders, whatever they may be doing, selling their bags, they're swapping our assets. They're giving some USDC, they're taking Bitcoin, they're giving Bitcoin, taking USDC, and all the fees they pay just go back to us. It's a business. So getting started, the most important thing will be the quality of your assets. Hopefully this is known already, even if you're just a hodler right now, because you're a retail store. You're selling two specific currencies. If you have a store that is selling goods and those goods go to zero, if you're selling just Pokemon cards and the craze just dies down, you now have little $4 packets that are no longer $400. You don't want to be buying assets that are going to go to zero. Unlike a bank, your capital is exposed. You actually hold those assets. That is your net worth in there. You do not want that to go to zero. If your product goes to $0 in value, so does your inventory of that product. And in a liquidity pool, because you're swapping between the two assets, so you have Bitcoin and something else that's trashy in there, if that trashy coin goes to zero, you slowly go to zero as well. Blue chip focus, only open liquidity pools with assets you truly believe in and that have a long-term future. If you hold something and you believe in it long-term, you're gonna have conviction. It's gonna take emotions out of the game. And if it does perform like trash or go to zero, you already held it anyways, so your downside risk has not changed. But don't build your house upon the sand. Risk should be a very small percentage of your portfolio, maybe 5 to 10% max. Yield chasing will always end in destruction, and it's always the last thing on my checklist. I'm looking for assets first, range is second, APR is the last thing that qualifies my position. Not sure how religious everyone is here, but this is a little quote from the Bible verse here, but everyone who hears these words of mine and does them will be like a wise man who builds his house on the rock. The rain fell, the floods came, the winds blew, beat on the house, but it did not fall. We want our portfolio to be the same way. A concrete foundation, the rock, Bitcoin, Ethereum. Don't build your future on microcaps, on meme coins, things like that, because there's no proof they will stay here forever. And again, don't chase yield. It will lead you to zero, black hole. TVL. So when we're looking for metrics, the first is asset quality. We want to make sure we have good assets. Second is the TVL. And for some of you, you guys will kind of know this game. Joe, I know this is new for you. TVL is essentially going to be both a proof of concept and also your competition. It's going to show that the more TVLs, the money locked in a pool, okay? So the more money there, it's showing you that it's profitable, people like it, it's safe. If there's a lot of money congregating there, it's because it's successful. You know, just like you think a stock. The larger cap the stock, the more people like it, the better it's performing. But it's also your competition, because it's the amount of people doing exactly what you're doing. So the fees, the actual money that that pool generates, gets divided amongst everyone that is providing the TVL. So what we're really looking for is a competitive edge, a high potential edge. The lower TVL you go, it shows that you have to kind of watch the warning signs. Like, why is it so low? Is it risky? Am I in a new location, a new blockchain? Is it a bad token? Which we shouldn't be if we're following step number one. But we're trying to find the edge between where we can have a proof of concept to where we have a good TVL, but we also can be a big chunk of the pie because we want to get a big cut of those rewards. When you're starting out, $100,000 minimum TVL is a great baseline to start, just to make sure you are not somewhere you are not supposed to be. We don't want you to be somewhere you don't belong and lose money. Make sense so far? Sweet. Volume. This one is the exciting one. This is how you actually get paid. It's the foot traffic. It represents the literal customers walking into your shop. Without traffic, even a high TVL pool is going to make no money. Even a low TVL pool is going to make no money. We have the input, volume, the fee tier, how much we're paying, which we'll show you in the live example kind of how that works. And the output is how much money you're actually making. We want high foot traffic on evergreen assets. We want to run a business forever. High volume on meme coins, you're gambling. You can make a lot of money, but again, your inventory can go to zero. We're trying to find assets we want to hold for the long term, and there's more than these as well, which we'll go over, but like ETH, Bitcoin, sustainable, long-term assets you can hold throughout volatility, and a sustainable business long term. And again, I covered in the last slide, but our secret edge here is going to be finding that peak area where we're getting high volume, but a more lower to mid TVL. Not super low, but we're trying to find a competitive edge to where we can make as most money possible on the safest assets possible. It's like an ATM. It literally is. So it's like you're trading two currencies. Someone's coming in, they're swapping their Bitcoin for cash. They're swapping their cash for Bitcoin. It's like when you get off the plane here in Thailand. You want to make sure you're going to the ATM. But keep in mind, foot traffic. At the airport, finding the best location. At the airport, lots of people are flying in, trading all their currencies for Thai bahts. You want to make sure that there is actually demand for those assets. You're picking the good assets. But TVL will be like your competition. If you're going off the airport and there's 10 different exchange counters, they're obviously going to be splitting that business. You're splitting it with more people. So you really want to try to find a place where it's high foot traffic, but not as much competition. You want to find a place like, and there has to be demand for the asset too. So you can't have a Thai bot counter back in the US because there's not really a lot of people coming from Thailand looking to trade their currency. It's just not the same game. If you have a Thai bot ATM, you really want to make sure it is in Thailand. And again, you want to make sure there is high demand outside Nana Plaza maybe, or outside the airport, you know, somewhere where people are actually going to need cash. There needs to be actual demand. And again, this is how we're going to make money. Making sense? Good? Good so far? So setting ranges for long-term success. When I first got started, I was going way too tight oftentimes, and that usually led to mistakes and then doing the worst thing at the worst time. What I have learned over the last probably about 3 years now in DeFi is that you need to zoom out. No 5-minute charts, no hourly charts. I'm literally looking, usually the closest time frame would be the 4-hour now, if not the daily, and if possible, the weekly. I'm going wide. I'm setting things up to where it affects me 0% emotionally when prices are swinging, and I'm making money every single day. I tell people oftentimes, like at our new member onboarding calls and stuff lately, if you were to get deployed in the military overseas for a year, would you be comfortable with the assets you hold and the ranges you have set? If not, you are probably in something that is either too risky of a coin or too tight of a range. If you're worried about going on vacation, you leave your laptop at home and you come back and your portfolio is going to be gone, you are completely playing this the wrong way. I literally can go a whole month and not check my stuff, and I check it, claim my money, and then that's that. It removes emotions because we're literally not trading. We're not taking bets. We're not gambling. We're trying to earn as much money as possible for the long term. All right, it's going to get a little heavier now. A little heavier. Inside the pool. So what actually happens? How does the composition of your pool change? So if again, some of you, a little bit of a refresher here. Joe, buckle up, here we go. Asset composition. You're literally a market maker, so you're taking your two assets. So it would make sense that if you're facilitating transactions, if the price is going up, that means there is high demand for an asset. And that means that tons of people are handing you cash. They're running at you with cash, and you are giving them your asset. So you start to get full of stablecoins. Does that make sense? Because they're giving you all your cash, and you're giving away your Bitcoin, you're giving away your Ethereum, etc. The opposite is true to the downside. When the market's nuking like it just has, and everyone's running for the hills, what they're actually doing is they're selling their Bitcoin to you. So they're selling their Bitcoin, they're running away, the price is going down, and so you start paying out people cash. So you start to become really heavy in the actual volatile asset. Bitcoin, Ethereum, Solana, whatever pool you are actually running, you start to DCA into that asset because you're handing all your cash away and you're buying it from everyone. And then in the middle, it's kind of 50-50. As you hit that middle of your range, and there's, you know, we're kind of in the middle of the market, in your middle of your range, you're holding a 50-50 of both assets because it's kind of in the middle there. People have sold their assets, some people are buying the asset, and you're at an even composition. You're just a store. You're running a shop. When price exits the top of your range, again, you sold all of your volatile assets into stablecoins, usually at a take profit zone. If you set wide ranges, like for me, I have some wide ranges on ETH at the top, Ethereum at like 4,500. At that point, I probably want to be taking profit anyways. It's already at a take profit zone, so I don't feel bad leaving with cash. If you go too tight, you're gonna get cashed out of the assets you want exposure to way too early. When price exits the bottom of your range, you have DCA'd in at a better price. You have bought the dip automatically, and if you, again, have set strong ranges, resistance levels, bottom of the market, you can just do nothing. Wait for it to mean revert, the market comes back into range.
Can you repeat the price exits top of range?
Yeah, of course.
So, price goes up, you just withdraw it?
That's definitely an option.
Back in?
Yep, it's definitely an option. So think, for example, Ethereum's at 4,500. That's where my top is. When ETH goes back, My pool, because I've been holding a lot of the asset as well, also gets appreciation. So I make profit on the way up, plus my fees every single day. And at the point where I reach the top, I'm all cash. So I now can look for a new opportunity that has not pumped yet, rotate to something else, a different altcoin, a different coin. I could open a new range, but if I have set really strong ones, it's probably a good time just to walk away, take a break. And I can also then like lend those stable coins, run stable coin pools, and try to make like 10% a year that way, maybe plus. And keep making money, keep the money moving, buy gold, etc. So you have lots of options, but usually if you set a really strong range, I like to not chase that price action because as we've seen time and time again over the last 3 years, it comes back. It comes back every time. Impermanent loss. So essentially, this gets demonized quite a bit. It is a tricky subject to talk about. It's worth noting that tomorrow, the strategy I'm going to teach everyone that puts everything together, it completely avoids this problem, but it is something to be aware of. Basically, first off, it is temporary. But what impermanent loss really is it's the difference between if you were holding, let's just say Ethereum again by itself. Ethereum right now is 2K. At 4K, it's doubled in price. You take profit, you sell it, whatever. In a pool, because you're paired with another asset, let's say USDC, you wouldn't appreciate as much, but you are making daily fees. So a couple things. First off, impermanent loss to the downside. Impermanent loss is your friend to the downside. If the market moves down, you lose money slower than anyone holding spot assets, plus you are making fees every single day. So you actually lose money slower. When the bull run comes, you will make appreciation a little bit slower, but again, you're still making fees. The longer it takes the market to move up, the easier it is to maybe even beat the impermanent loss, if not break even with holding that spot asset itself. Now, again, it's temporary. A lot of people, I think maybe even a lot of people in this room, did we sell all of our bags at the all-time high?
Hell no.
No. So it's impermanent. So the thing is, your ETH doubled in value to 4K, and now it's right back here. So if you haven't taken any money, you've literally made $0 if you took no profit, whereas the pools were printing the whole time. Up, down, so you're now above where you started because you've been printing. Let's say you're printing 10% a month every month. The last 6 months, it's an extra 60% you've made. Whereas your Ethereum, you were holding spot, you thought you were gonna sell the top, no one ever did. You probably bought the top. Yeah, it's a different story. Hopefully that kind of makes sense. We'll again cover this more tomorrow as well with the flywheel strategy. But it just means you're selling your assets as they pump. So you're literally taking profit on the way up. So you're taking profit without having to actually manually go in there and do it. Because as we know, a lot of us, traders especially, they get emotional and they're buying the tops and selling the bottoms. This actually has you doing the right things. You're buying the dips automatically and you're selling the tops automatically. And we're here for yield. If your pool is earning APR and you suffer a little bit of impermanent loss, usually that APR, especially if it takes long enough, you actually can out-earn the difference if you have wide ranges. So when to exit a liquidity pool? I like to think of it as a supercharged swing trade. So I'm setting wide ranges. Daily time frame, weekly time frame, highs and lows in the market. And the longer this trade takes to complete, the more money I make. If I'm making 10% per month, I'm building my bag at 10%, whether Ethereum is still sitting at $2,000 or it's already pumped to $4,000. The longer it takes, it's just a supercharged freaking swing that gets bigger the longer it takes. It's literally so perfect. When I finally complete the trade and it goes to the top of my range, you were kind of asking about this.
So you kind of set and forget
Yes.
for 1, 2, 3, 4 months?
Longer. I've had pools open even longer than that before. As prices rise, the pool will automatically sell your assets into the stablecoin or the more blue chip asset, and you're taking profit the whole way up. So it's doing literally all the hard work for me. At the top, actually, let me go here real quick. The longer the pool runs, again, the more the fees are compounding. So the longer it takes, the more time, the more money. And you got to think as well, if you're earning 10% a month down here with Ethereum at $2,000, and you say you're just reinvesting that into Ethereum on the side, that 10% a month you're making, when Ethereum goes back to 4K, in hindsight, that was more like you were making 20% a month. Because every $1,000 you're reinvesting at 2K is now $2,000. So the longer it takes, the longer you get the shitty market at the bottom, the more powerful this really is, and the more it exponentially can grow your portfolio. Now, as price drops, you accumulate more of the assets. That's literally what I just said, JK. Exit criteria. So the only time I close the pool early is if I don't believe in it. Black hole. Lost conviction in that completely. I lost belief. Think it's a trash, more like a meme coin now. It didn't do what it was promised. Alex Becker, big names behind the coin. I no longer believe in it. I think it's just, it was a promo. They made a lot of money off of it, and a lot of people lost money. I dumped that coin. Dead project to me. Still use the ecosystem, but I don't hold the coin. Market structure broken. Do you think we're going to zero? Well, you shouldn't have the pool open because you're taking inventory of assets. If you truly believe we're going to zero, like Bitcoin, quantum computing's coming and like it's game over, you probably shouldn't have your pools open. Price at a range to the upside. This is a good problem. You finally taken profit. Jake, he hasn't, on YouTube, he hasn't taken profit. People make fun of him all the time in the comments, and it's like, he finally did. He finally took profit on something. You successfully exited your swing trade, and you can redeploy somewhere else that hasn't pumped, or you can take your profit and go spend it on something, actually enjoy a trip, take a vacation, buy something you need to buy, lend it out, make 10% a year, which we'll cover again tomorrow as well. And if you've got to range to the downside, we have more options we can talk about tomorrow, but you don't panic. You're just holding, let's say, Ethereum. You've DCA'd into Ethereum at the best price possible, and now you're holding. It's the same risk that literally everyone sitting here has now. Are you holding Ethereum? Same risk you have now, except you actually lost less money and you made fees the whole way down. If I do go out of range and I'm thinking about changing my range, I always wait at least 48 hours, or you can then open a short to try to hedge your downside, which we'll talk about day 3, actually. And we have VFAT time. So basically, once Jake gets back in here, we're going to do Q&A. We're going to do a live example of everything here, like actually get some pools open. Anybody have any questions off the top real quick? Just like burning stuff, if you wrote anything down. It's kind of just a general overview of the process. And then we'll just... VFAT. Yeah. It's just one of our favorite tools to use to open liquidity pools.
Like what happens if you set the ranges and the price goes beyond the range?
Up or down? Up?
Up, yeah.
Cashed out.
You just automatically sell.
Which we're going to show a live example, but yeah, it sells you slowly the way up. So it's actually like there's a curve the whole way up, and you're slowly selling on the way up.
When it hits that range, you just don't have anything in the point, right?
Cash.
You just have.
And once it leaves, you no longer make money, but you're just holding cash.
Is that into the you like stable coins? You sell into.
Yep. Oh, it depends on the pool. There are asset to asset. So you might, let's say you have ETH and Bitcoin together, and ETH's pumping, it starts to sell you into Bitcoin, and then at the top, you're just holding Bitcoin. So we'll show some examples here together in a second.
But this is why you only want to do it coins you like. At the end of the day.
And it's why you don't want to go too tight. If you go too tight and you get cashed out way too early, now you're stuck facing like, okay, fuck, do I have to buy Ethereum at 3K now and I already had it at 2K? So you want to make sure you spread it out.
But I know, like talking about Ethereum, say, what is it right now, at 2 or whatever? It goes to 3, you know it's going to go up. You would still cash out and buy back in?
I would
rebalance it?
I would set my range higher to begin with.
Okay.
And I would do it sooner than later. Yeah.
When you've set it, can you change the range?
Yep. But you need to keep in mind what's going on, right? So, which we'll be able to show you better when we screen share. But say I have a pool now, and I'm about 75% in cash, and I do change my range, I'm going to be taking some of that cash still and be buying more Ethereum at the current price because I'm changing my composite. It's a little complicated. It'll be easier.
Yeah, so you're better off just sticking to what you do.
So I really try to do everything right the first time. Because later on when you make change, especially right now, everything's such a good value zone. Later on, if you're making changes, if you have to rebalance, you're usually doing the worst thing at the worst time. Because it's too high, and then you're changing, you're buying back in at a high price.
Have you seen, like if you're in a wide range where you're making less APR, how could I say it? Like if you're in a tighter range now and just rebalance later, wouldn't you be making more? You know what I mean?
The numbers don't work out because,
okay.
So I'll tell you the problem. Let's see. Let's see what the best slide is. To show, I want to do it on this one probably. So it's like, price goes up. Say you have like a 10% wide range. Like, let's just say it's like $2,000 ETH to $2,200 ETH. You have basically no upside exposure because in that 10% band, you cash out the stable coins. You get pushed to stable coins right away. So you're not really going to get any upside, and you're really going to be hoping that it stays in that really tight range for you, which I've done these tight range, 12% wide ranges before. Yeah. It doesn't work out. Cash flow is really good. You'll be getting like 300, 400%, but it's not sustainable. And your downside is almost basically 100%. Because if the market goes below 2K, you just DCA to ETH, and you'll ride that down wherever it goes. Yeah. And then when the market finally pumps, because crypto is volatile, and you make a lot of money at that upside, you're not going to get any of it because you're going to get cashed out ASAP. You're going to get like 3 or 4% max because you're going to get cash into cash pretty quick.
So yes, tight ranges are for traders, wide ranges are for investors.
I would agree. So I mean, it's just a business where it's like you want to be making money every day, and over the long term, you're going to make a lot more money running a wide range than you ever will a tight range.
More like a steady, slow race, I guess, if you have the ranges wider.
Exactly.
Trying to make.
And then with tomorrow, we're putting some things together too it's just going to supercharge the portfolio a lot more. And then with a wide range as well, it'll give you the opportunity to, in the bear market, be able to short and try to hedge positions. Whereas if you're going tight, it's going to be almost impossible to manage because your composition will change too fast. So, yeah.
Can you leverage the liquidity pools?
You actually can on some of them, but tomorrow we'll be showing more about leverage. Yeah, there's some that you can't though, actually. Yeah.
Why do some tokens have DeFi protocols versus like other tokens that just don't exist?
Yeah, no, that's a good question. So a lot of my investing thesis changed as I started getting into DeFi. So I was in a lot of projects that just, they sounded cool. YouTubers tell you to buy them and things like that. As I started to actually get on chain, I figured out what assets actually have volume, what assets have demand, what assets actually have this whole on-chain ecosystem where you can send people money whenever you want, you can trade whenever you want, you can buy other coins, there's protocols, you can lend money, borrow money, swap, provide liquidity. So I've spent a lot of time in this space finding these actual protocols, and a lot of my portfolio has transformed to what actual blockchains support those activities. Hence why I don't have XRP.
Right, but why wouldn't it exist on like XRP or like ECH, for example?
Yeah, I mean, to be honest, why they don't have one, I'm not entirely sure. I mean, they haven't structured for that. No one's building these protocols on those ecosystems. And there's new coins that come out that have them, and there's some smaller ecosystems elsewhere, but there's some tools like DeFi Llama, which we can show as well, which will show you the actual, like, for example, I remember Celestia was a coin I bought. I don't know if anyone knows that coin. No? It was a new one that came out a couple years ago. I was getting started, and I think I've sold out of it, by the way, but last week they made $14 in revenue. So, and that's just showing you like there's no actual activity there. People were kind of farming it for airdrops, and once the airdrops were over, it was GG. Like there's no actual community and ecosystem there. The things that are surviving the bear markets like right now, where those chains are still making money, people are still lending money, borrowing, there's a whole ecosystem. That's where I want my money to be. And so that's why my portfolio has slimmed down significantly to what's actually profitable, making money. From a business mindset, especially. Guys, hopefully there was insane value in there for you. Hopefully you took great notes and you could implement and open your first pool literally today. Get started today. If you want to work with me, you can book a free call down below. The Mastermind Day 2, I'll have up here. If you're watching this when this Day 1 first goes live, it's going to take a couple days for Day 2 to come out, but it will be right up here. And if not, it will be coming soon. So again, guys, book a free call with me down below. Let's get started as soon as possible. And I hope to see you on the other side.